I would now first like to focus on growth. In this high voltage global environment, it is useful to take stock of domestic macroeconomic and financial conditions. The rebound in domestic economic activity that took hold with the ebbing of the Omicron wave is turning out to be increasingly broad-based. Private consumption is regaining traction on the back of recuperating contact-intensive services and rising discretionary spending. The forecast of a normal southwest monsoon in 2022 for the fourth successive year has brightened agricultural prospects, and this should support rural consumption. There are also signs of an incipient revival taking place in the investment cycle. This is reflected in high frequency indicators like imports and production of capital goods, rising capacity utilization supported by conducive financial conditions, and stronger corporate sector balance sheets. Export growth has remained buoyant, while persisting high growth in non-oil, non-gold imports reflects a durable revival in domestic demand. Even as the drivers of domestic economic activity are getting stronger, they face headwinds from global spillovers in the form of protracted and intensifying geopolitical tensions, elevated commodity prices, COVID-19 related lockdowns or restrictions in some major economies, slowing external demand, and tightening global financial conditions on the back of monetary policy normalization in advanced economies. These risks are evolving on the lines anticipated in April 2022 statement and appear to be lingering. Let me turn to inflation now. The sharp acceleration in headline CPI inflation in March 2022 to 7% was propelled in particular by food inflation due to the impact of adverse spillovers from unprecedented high global food prices. 9 out of the 12 food subgroups registered an increase in inflation in the month of March. High frequency price indicators for April indicate the persistence of food price pressures. Simultaneously, the direct impact of increases in domestic pump prices of petroleum products beginning the second fortnight of March is feeding into core inflation prints and is expected to have intensified in April. Looking ahead, food inflation pressures are likely to continue. Food price indices of the Food and Agriculture Organization, that is FAO, and the World Bank touched historical highs in March and remain elevated. Spillovers from global wheat shortages are impacting domestic prices, even though domestic supply remains comfortable. Prices of edible oils may firm up further due to export restrictions by key producing countries and the loss of sunflower oil output due to the war. Elevated feed costs are translating into escalation in poultry, milk, and dairy product prices. International crude oil prices continue to hover above $100 per barrel, and this is prompting pass-through to domestic pump prices. The risks of unprecedented input cost pressures translating into yet another round of price increases for processed food, non-food manufactured products and services are now more potent than before. This could strengthen corporate pricing power if margins get squeezed inordinately. To sum up, the strengthening of inflationary pressures in sync with persistence of adverse global price shocks poses upward risks to inflation trajectory presented in April MPC resolution. In these circumstances, it is necessary for monetary policy to focus on withdrawal of accommodation. It may be recalled that in response to the pandemic, monetary policy had shifted gears to an ultra-accommodative mode with a large reduction of 75 basis points in the repo rate on March 27, 2020, followed by another reduction of 40 basis points on 22nd May 2020. Accordingly, the decision of the MPC today to raise policy repo rate by 40 basis points to 4.4%, 4.40%, may be seen as a reversal of the rate action of May 22, 2020, in keeping with the announced stance of withdrawal of accommodation set out in April 2022. So in other words, in last month we had set out a stance of withdrawal of accommodation, and today's decision should be seen as a continuation of that announcement. We had also said last month that the situation is constantly changing, fast changing, and our actions will be tailored accordingly. And what we are doing is to reverse the increase of 40 basis points, the reduction of 40 basis points in the repo rate, which was done 2 years ago in May 2020. We are just reversing that 40 basis points today, and this is precisely in line with the stance of withdrawal of accommodation, which was set out in last month's MPC statement.
If you like the video, do like, comment, share and subscribe.